Hello and welcome to another episode of the Mark Moss Show, where we talk about each and every week we talk about the decentralized revolution, the way the world is changing right before our very eyes as we swing from a period of centralization and moving back towards decentralization. We look at it through the lens of politics, finance, and technology. And there is no shortage of things to talk about each and every week, so it makes my job pretty easy. Actually, my job is pretty hard because there's so much news. I have to figure out what to get rid of and what's important. There's so much noise, as we say, and so it's trying to find the signal in the noise, trying to find the signal to bring to you so I can just cut down the amount of time that's required for you to stay on top of these things and see what's going on. And I got a lot to cover this show. Hopefully you'll stick with me through the whole time. We got a lot to cover. I know it's a long show. We'll break it into segments. If you can't stick around to watch the whole thing or listen to the whole thing, don't worry, I got your back. You can check out the recorded versions later on the podcast. Just search Mark Moss Show on your favorite podcast player, iHeart player, iTunes player, etc. And you can also find it on YouTube. Just search Market Disruptors on YouTube, and you'll find them where you can actually watch me and listen to me at the same time. But we got a lot to cover. I want to carry on from actually some of the topics we talked about last week, which is some of the topics we've been talking about for like over a year. And these are topics that don't go away because it's literally, I don't want to say it's the thing that's driving the direction of the world right now, but it kind of is. It's also what really changes the dynamic of what's driving the world. More importantly, it changes the ability to affect some of these changes, some of the tools that are taken into place. So it's literally the biggest thing that there is to talk about, so we talk about it a lot. But it signals that the end is near. When I say the end, I don't mean we're all going to die in some apocalyptic vision of the future, but the world as we know it is changing. It's changing rapidly. And so we look at those signposts. So anyway, we're going to talk about that, kind of carrying on from where we talked about last week, which the big data this week was the new CPI print, the Consumer Price Inflation Index that got released. And it tells us what's happening with the battle that the Fed and the government is dealing with. A lot of things that goes into that. We'll talk about that. We're going to talk about, yes, of course, the technology piece, which is Bitcoin, the decentralized revolution, technology. We're going to talk about that, what's going on with that space. We're going to talk about just the overall economy. Some big things happened this week, specifically that was keyed off of this CPI print and with what the IMF is coming out and saying. We're going to continue to look at the breakdown, or I should say the pendulum swinging from centralization to decentralization, looking at some things that are happening all throughout society that kind of show us these signposts that we can see how it's changing. We're going to get into some energy talk. Of course, we talk about the energy thing a lot. And then we're going to talk about the search for truth. This is one of the biggest catalysts that is changing the world right now. We're going to talk about that as well. So anyway, a lot to cover. Hopefully you stick with me through the whole time, but don't worry if you don't, if you can't, no worries. I got your back. Like I said, go check me out on the podcast, Mark Moss Show on the podcast player, or on YouTube under Market Disruptors. By the way, if you're not following me on social media, you should. Just check me out at @1MarkMoss. I put a lot of stuff out, multiple times a day off of what I'm seeing. So you don't have to wait one time a week to see me or catch me here. You can stay in touch with me on a regular basis on social media at @1MarkMoss. But let's go ahead and just jump right into this. So as I already kind of said, it kind of carries on from last week. Last week I said that the central banks, the Federal Reserve, is fighting the wrong war. That was kind of the topic of last week. It's pretty important. If you missed it, like I said, go back and check it out on the podcast player or on YouTube. But the central banks, I said, were fighting the wrong war. And what I meant by that is that they're fighting inflation, right? But there's two ways to tackle inflation. So inflation, in the terms that we're talking about, is the increase in prices. The reason why you can barely afford to fill up your grocery cart with groceries, why you can barely afford to fill up your car with gas, and that's because the prices of everything is going up so fast. And there's two ways to affect high prices. Just two levers: supply and demand. So I can bring more supply to the market. If there's more supply, if there's more goods, then there are people to buy them, then the price comes down. If there's more people wanting to buy the goods and not enough goods to go around, the prices go up. So they can just bring more supply to the market, which sounds like a great idea. More abundance for everybody. Or The much worse option is they could destroy demand. So you're just so poor, you're just so broke, you can't afford to buy anything. And if you can't afford to buy anything, then I guess there's less demand than there are supply. And so, as I said, they're fighting, the central banks, the Federal Reserve, is fighting the demand side of that, meaning their goal, their stated goal, meaning all over the news, they've said it in all their meetings, their goal is to crush the demand. Not add to supply, crush the demand. Now, of course, the Fed, the central banks, can't print food. They can't print energy. They can't print any of those things. Now, they could potentially, use some money. They could pressure the government to relax regulations to allow people to bring more goods to market. That would be great. Then everybody gets more wealthy because now people have more jobs and there's more manufacturing, there's more production. We all have more goods to buy at cheaper prices, so our quality of life goes up because our money that we have saved or money that we're earning buys us more goods and services. That sounds great. Sounds like a great world. But that's not what they want. They want to crush the demand. They want for you to be poor. They want for your retirement account to be cut in half, your house to be cut in half. They want your job to pay you less money. The fact that the employment market is tight, meaning there's not a lot of jobs open, which that's a complete manipulated number. We can talk about that more later. But the fact that your job is offering to pay you more money is in direct conflict to what they want. They said they're committed to it, committed to bringing prices down. They're committed to it. They need for prices to come down. In order for prices to come down, the amount of money you make has to come down. Because if an employer has to pay you more money to recruit you to their business, then that employer now has to raise their prices to pay for you. So if McDonald's workers get paid more money, as in California, Governor Newsom wants to pass a bill that all fast food restaurants have to pay people like $20 minimum. Well, okay, so let's pay everyone $20 minimum. But now those fast food restaurants, still needing to make a profit, will have to increase their prices. So now the burgers cost more money. That means then food prices go up. That's inflation. The Fed is trying to get prices to come down. So if you make more money and the prices go up, that is a problem. Do you understand what's going on? The Fed needs you to be poor in order for them to achieve their goals. Now, again, the other way to achieve the goal is let's just bring more supply to the market. Let's just bring more steak, more food, more energy. Let's just bring more to the market. Then we're all abundant. Then we can buy all that we want. Our money goes further. We all have jobs. We're producing goods and services in the economy. Sounds great, but again, they're fighting the wrong war. And the reason why I say they're fighting the wrong war is because the reason that prices are going so high is not because of too much demand. They think that there's too much demand, too many people buying things. That's not the case. The problem isn't that we have too much demand. The problem is that we don't have enough supply. So they're trying to bring the demand down to match supply, but that's a war they can't win. We talked about it last week. Again, go back and listen to that. But back to the news at hand this week, US Core CPI surges to a 40-year high. 40-year high. We keep talking about 40-year high, 40-year high, 40-year high. Well, it's because we keep setting records. And we go back to 40 years when the famous Reagan era, when inflation was double digits, and Paul Volcker, who was then head of the Federal Reserve, had to raise rates to 20% interest rates. Mortgage rates are at all-time highs, not all-time highs, recent all-time highs. They're back all the way up to 7%. Imagine them at 20%. And that's where we were 40 years ago. So that is what they're comparing us to. But again, this week we announced, or it was announced by the BLS, the Bureau of Labor Statistics. They announced that, again, CPI, Consumer Price Index, or the inflation prices that you pay, going up to a new 40-year high. And it says that, or what we need to understand is that this data tells us what comes next. Okay, because the Federal Reserve, the central bank, while they have been reducing the money supply, they do that by increasing rates. And they said they're going to stick with it, bringing prices down, until the job is done. Well, stick with it is crushing demand. Until the job is done, what's the job? Bringing prices down. So because prices have gone back up again, it tells us what comes next. And what is that? Well, that means they have to stick with it. What's it? Raising rates. more rate increases, more restrictive monetary supply, more wealth destruction for you. That's what that means. So probably the next at least one, if not two meetings, we can expect a very aggressive Fed, what we call a hawkish Fed, to happen. We see that it says headline and core CPI, so those are different numbers. Headline and core CPI printed hotter than expected. Now, when you're putting out, when you have a goal, you're hoping to bring inflation down, and then you set expectations, or you're a business, you're hoping to make money, you set projections of how much money you can make. When you don't meet those goals, that's bad. And they came in hotter than expected. So the goal is to bring it down. Many analysts and the Federal Reserve had expected it to be lower than it was, but it came in higher. So headline CPI, which is their average basket of prices, rose 4% or 0.4% month over month, which was double their expectation. So it came in 100% worse than what they expected. 100% worse. Not a little bit worse, double what they expected. And it's up 8.2% year over year, which is hotter than it was last month. Now that's headline. Now they have core CPI, and this is what's a little bit interesting, is core CPI is when you take out food and energy, which is a funny way to calculate it because the two most important things that we need to stay alive as human beings is food and energy. I mean, we could say the food is energy. Food is energy for our bodies, right? It's calories for our bodies. So food and energy, if we remove those, then we get core. So who cares about everything else? All we should care about is food and energy. But anyway, core CPI is up 28 straight months, soaring to a high of 6.6% increase year over year. It's the highest since August of 1982. Now, one thing to keep in mind about these inflation numbers going up, the 6.6% year over year, 6.6 doesn't sound very bad, right? But this is a cumulative, all right? So it was up, I don't have the data in front of me. It was up, whatever, call it 5% last year. So it was $100, it went up by 5%, it's 105. Now it goes up 6%. Well, that's 6% on the 105. So this is the high inflation increase on top of an already high inflation increase. So the numbers just keep getting bigger and bigger and bigger, which is why it keeps getting harder and harder and harder for you to live. Now we see that services inflation continues to rise as goods inflation slows. So what does that mean? So goods, so like products. The goods inflation is slowing down a little bit, but the services inflation continues to rise. The services is because of your labor. Again, as I said, the fact that you make more money is a problem for the Federal Reserve, for the central banks. So we're seeing services, people are getting paid too much money. You're not getting paid too much money to live, to keep your quality of life, but you're getting paid too much money for what the Federal Reserve's intentions are. We can see that, jumping back into the headline CPI, we can see that food inflation remains extremely high. We see that the owner's equivalent of rent also increased 0.8% over the month. It's the largest monthly increase in that index since June of 1990. So the rent increase is going up. Shelter inflation went up 6.5%, up from 6.25% last month, and the highest on record. Rent inflation is up 7.2%, up from 6.74% last month, the highest on record. CPI says that shelter index also rose 6.6% year over year. Now, it's important to know this metric, and this is a little bit of manipulation. So it went up 6.5%, 6.6% year over year, and this accounts for 40% of the total increase of all items in the core, so excluding food and energy. But the thing that's also to understand is that this is a lagging indicator because rents are typically locked in usually at least a year at a time. And so we don't see this until those rents get reset. You've got a lease, you've been there for 2-3 years at this low rate. Well, when you leave that lease and they sign somebody else, they raise those rents big time. They don't do it a lot of times if you're still there, or maybe they just do it very small. But when you move out and they move somebody in, you get a big increase. So you have to understand these are really, really lagging. These are really far. We also see that, again, as I said, your wages going up is a big problem. And as what we've seen is that what's called real wages are lower for Americans for the 18th straight month. Now, what are real wages? Real wages are when you adjust it for inflation. So that means that the increase in your wages is going up slower than the cost of goods. So even though people are still getting paid more and more money because the prices of goods are going up so much faster, they're still falling behind. You're getting a pay raise, but your quality of life is still going down. That's basically what's happening there. Now, a couple things that I want to point out about this. Like I said, even though you may be making more money, your quality of life is going down. And thanks to the Fed, thanks to the central banks, you're going to be able to, I should say it differently, you're going to be forced to work more this year just to have the exact same quality of life that you had last year. So you don't get any improvement. You don't get any more stuff. You don't get any more time off, any more dinners. You don't get any more time with your family. You don't get any of that, but you get to work more. You get to give up more of your life. That's what's happening. It says here that real earnings, again, right, that's adjusted for inflation, are falling. Savings are falling. And more people are taking on second jobs just to make ends meet. The central banks printing money, causing prices to go up, is literally stealing your life, your actual life, because now you have to go work more hours for the same exact quality of hours that you could spend with your kids, hours you could spend with your wife so you don't get divorced, hours you could spend with your kids so they don't turn out to be crazy derelicts, hours that you could spend on your education so you could learn to make more money, hours you could spend on a new job, a side hustle, so you could become financially independent. But nope. You can't spend any of that time. Now you are forced to go get a second job just to keep up with the same quality of life that you had before. So, yes, you still feed your family. They just don't see you anymore. That's basically what the Fed has done. And we can see this very easily because what we can see is that while the total jobs have shown strong growth, we can see the total number of employed persons has actually been coming down. So what does that mean? That means that the job growth that we've seen, it's really just a matter of people working a second job. That's what it means. So the job growth looks good, but we don't have more people working. As a matter of fact, while the unemployment data looks good, if you dig a little bit deeper, it's not that good. So we have something called job participation rate. While the job participation rate looks at all the people that are eligible to work and how many of them are actually working or looking for a job. The unemployment data only looks at people who are actually looking for a job. But as more and more people just give up and all just live on welfare, then it doesn't count those people anymore. So we're seeing the job participation rate is falling like a rock. And what we can see, CNBC said that nearly 70% of Americans are looking for extra work to combat inflation. 70%. 7 out of 10 Americans are looking for extra work to combat inflation. Thanks to the Fed. Thank you, Fed. Appreciate that. Everybody like that? That's the central bank. That's what you get for having a central bank that manages the amount of money in the system. It's insane. It's insane. Now, I'll just bring your attention back. In Karl Marx's Communist Manifesto, he lays out 10 points of communism. Now, I know a lot of people say that all these high prices are because of capitalism. It's capitalism's fault. Capitalism has run crazy. Capitalism has led to all these big, greedy oil companies that charge too much money, and these greedy gas stations that make too much on their gas, and greedy food companies, and all this capitalism has ruined everything. But in Karl Marx's Communist Manifesto, he lays out 10 points of communism. In order to get communism in a country, in a nation, there's 10 things that have to be there. Number 5, the creation of a central bank. A central bank is communist. It's not capitalist. It's communism that is causing this. It's the central bankers, communism, that trying to control the money by printing more money, by creating more money, it pushes down, it devalues that money. So now it takes more money to buy the same things it did before, which means now you have to work more than you did before. And now 70% of Americans are looking for extra work to combat inflation. Thanks to the Fed, thanks to the central banks. It's not capitalism, it's communism. They say that already 85% of Americans said that they've changed their spending habits. They've had to lower their quality of life. Now, instead of buying steak once a week, they just eat hamburger meat. Instead of hamburger meat, maybe they're eating Spam out of a can. I don't know. But they've had to change their spending habits due to inflation. 72% say it's impacted the way they view their job. 57% have sought out new or additional roles in the past year, meaning they need second jobs. CBS said that as U.S. inflation is racing ahead of worker wages, meaning your wages aren't keeping up, a growing number of Americans are taking second jobs to make ends meet. We already know that. The data tells us that. This is the American dream the Federal Reserve has given you. This is the new American dream the Federal Reserve, the central bank, promises you. We were warned by our founding fathers many mornings from Thomas Jefferson and many others that warned us that central banks would be more dangerous than standing armies. That the central banks would leave us Americans broken, penniless on the continent that our forefathers gave us. Central bankers just take it all. They steal it all. And you can't afford to live. This is the American dream the Fed has given you. What is that American dream? Well, the American dream that you get to work more jobs. You get to work longer hours. You get to keep paying those bills that are growing faster than you can keep your head above water. That's the dream they give you. It's not a dream I like. It's not a dream. It's more like a nightmare to me. I think what most people want is they would like to work less hours. They would like to spend more time with their kids. They would like to spend more time with their husband or wife. They would like to be able to, learn new things, try new things, pick up a hobby. That's what most people want. That's the American dream. Provide for my family, right? Have those nice things. But not thanks to the central bank that wants to keep creating money out of thin air. Not thanks to them. Now, what is this all telling us? Well, we're seeing that job openings are falling, as a matter of fact. They fell to a 14th month low in August. The economy is getting crushed. The U.S. economy is finally experiencing what was already in the cards in late 2019. And what is that? A recession. Probably a depression is what we're on our way into. This was staved off because the Federal Reserve and the central banks printed trillions and trillions and trillions of dollars. They fired up the money printers to keep it temporarily going, right? Kicking it down the road. And so now instead of a recession, we might have a depression. Right? And on top of a depression, we also have prices at 40-year highs. And like I said, the Federal Reserve is the cause of all this. Now, talking about rents real quick, and just to tell you that what you see is not what you get. So, they say that the shelter index rose 6.6%. It went up. But remember that shelter index accounts for 40% of that basket, 40%. So if it went up 8% instead of 6%, it really moves that needle because it's 40% of the basket, which is big, right? And they said it went up 6.6%. But per rent.com, they update the numbers on the 15th. So I don't have the October numbers. This is as of November 15th. A two-bedroom unit in the United States nationally went up 23.5%, and a one-bedroom unit went up 27% year over year. So they say, the BLS says it went up 6%, 6.5%, 6.6% to be exact. Rent.com says it went up by 27% for a one-bedroom and 23.4% for a two-bedroom. Now, which one's more accurate? Well, how does the BLS get the data? Oh, they do a poll. They call a couple homeowners and say, what do you think you could rent your house for? Like that homeowner knows. The homeowner doesn't rent the house, they live it. They're probably not real estate professionals. And how many people do they call in how many different markets? I'm thinking rent.com probably has better data. They pull from the entire nation because, we do have like an MLS database that they can pull it from. And so I think that number is much more accurate. Now, if it went from rent.com says 27.1%. Now, this was for September. If it went up, instead of 6.6%, it went to 27%, and it makes up 40% of the basket, what does that do to the numbers? Yeah, it blows them out. Big deal. Now, let's put this into some numbers that you can actually understand. And I want to show you what this means to you over a long period of time. All right. So, like I said, just this week when those numbers came out, it crashed the stock market. As a matter of fact, the Dow dropped 500 points, which is a really big move off of that. Bitcoin dropped. Everything dropped off of that. A sea of red across my screen of tickers. All right, but look, we're only in probably the first stage of what's probably going to be a multi-stage disaster. It's kind of like, up here we have like these mountain passes in the wintertime, and like you get this crazy fog, and you can't see, and so you start getting this pileup, and then more cars, and it starts this pileup, and it's probably something like that. We have this bubble, this massive, massive bubble that's been created by the central bank, by Greenspan, Bernanke, Janet Yellen, who's still around now, Jay Powell, and that's what's caused the consumer price inflation. But I want to show you what this means to you and your investments in your retirement account over a long period of time, and why your strategy that you're having right now probably is not going to work. I am going to tell you right now what this means to you right now, what it means to your retirement account, what it means to your investing that you're doing so you can retire one day, and why, if you don't learn to look at this differently, it's not going to be good for you. So this bubble that we have, it's created by the central banks. They're still in your life. I've covered all that. Our central bank leaders, good old Alan Greenspan and, Ben Bernanke, and yes, Janet Yellen, who's still around today, creating disastrous policies. And she says, we didn't know there was going to be inflation. Jay Powell, they're the ones that cause the inflation. And like I said, we've been breaking it down what these numbers show us this week, but let's look at what's happening now off of this, and let's get some perspective. So the inflation numbers that we're seeing, they guarantee us now that we're going to have to stay in this deflationary stage of this disaster for a while. Like I said, we're probably in stage 1 of a multi-stage event. All right, they're going to stay in this because, as Jerome Powell said, we're going to stick with it until it's done. Stick with what? Crushing demand. So they're going to stick with that for a little bit longer, and they're going to stay with it until something happens. Everyone's waiting for the pivot, and the pivot will come. But when will it be? Well, it's going to be when something breaks. What is going to break? The liquidity in the system. Most likely it's going to be in the debt markets, in the bond markets. All right. It could be a major pension fund that could blow up, like we saw over in the UK and the Bank of England. The BOE had to step in and bail them out. So it could be a major pension fund like CalPERS. CalPERS has a $500 billion in assets. That'd be pretty bad. It could be a Wall Street finance house like BlackRock. BlackRock has $8.5 trillion in assets. Could be some big corporations too big to fail, kind of a thing like that. But what we do know is the longer the Fed stays on this course, sticking with it to try to get rid of inflation by crushing demand, the closer we're going to get to a pivot. All right, we don't know exactly when, but we have some ideas. Now, most people think that this pivot's going to happen and things go back to normal. What's normal? Well, markets, asset prices going up, and inflation subdued. They think the Fed can get the inflation under control, and then we can get prices to go back up. But I think there's a big difference with how young people look at the situation versus how older people do. When I say younger, I'm talking about anybody under 60. And the reason why I'm saying anyone under 60, because anyone under 60 has no recollection of what the financial world was like before 1980. Now, I do. I study history, but I didn't live through it. But anyone under 60 really has no idea. And so what they think as normal isn't really normal. As a matter of fact, there was nothing normal about the 1980 to 2020 period. Is it normal for stock prices to go up by 36 times? Is it normal for real bond yields, the debt, to start at teens, the amount of interest owed on the debt down to zero? Is it normal to increase debt and have no interest expense? Is it normal for the federal government to multiply its debt by 30 times? Because that's what we've seen. So we're going to go back to normal. Is that normal? It's certainly not normal. It was an anomaly in time. Now, this anomaly has created massive distortions in the market, like all these zombie corporations. Zombie corporations are corporations that don't make enough money to even pay their debt. The rise of NFTs and these JPEGs that are of apes that are in like 8-bit graphic format to go for hundreds of millions of dollars valuation. billions of dollar valuations for companies that have no way to earn money or ever pay that back. That's what we've been seeing. Now, most people in this thinking this period is normal is that stocks always go up over the long run, right? Yeah, there's sell-offs, but if we buy the dip and we wait long enough, things are going to work out. And so all we have to do is have a balanced portfolio of stocks and bonds, right? That's what your financial advisor is telling you. And if your financial advisor is telling you that, you better watch out because they're wrong. Now, maybe they're right. Yes, things in the long run, they always pay off, but maybe not in your lifetime. And of course, you want it for your lifetime, right? So maybe not in your lifetime. So let's look at it in terms. We can see that the pound sterling's crashing on the dollar. The Turkish lira is crashing on the dollar. The euro's crashed, down 20% on the dollar. Turkish lira's down 85% on the dollar. But the dollar's strong, right? Look at the Dixie; it's going up. How do we see the dollar going down? Well, we see the dollar's crashed 68% to the S&P 500. But if we look at it in terms of gold is kind of what real money is. Gold's been money for 5,000 years. So let's look at it in terms of in price of gold. If you bought stocks in the late 1920s, you would have gotten all 30 Dow stocks in exchange for 16 ounces of gold. Then by 1933, about 13 years later, you would have lost 90% of your money. 30 Dow stocks, all of them for 16 ounces of gold, you would have lost 90% of your money, and you would have had to wait for 26 years just to get back to even. Now, what if you were trying to retire in those 26 years? It would have been very difficult. Same thing in the 1960s. Now, in the 1960s, your financial advisor would have said, just stay in the market. Don't try to time the market. It's time in the market. All you got to do is just buy good companies and just hang on, right? So if you own stocks in the mid-60s, your 30 Dow stocks would have been worth as much as 24 ounces of gold. That's pretty good. But then as it started dropping, it took 15 years for the market to hit a bottom in 1980, and you would have been down 93%. 93%. I can't afford to be down like that. I'm trying to retire. Then you would have had to wait another 17 years just to get back to break even. If you had bought stocks at age 40 in 1965, you'd be 72 years old in 1997 with not a penny of profit or gain to show for it. If you followed your broker's advice and stuck with the program, today you'd be 97 years old, and instead of stocks worth 24 ounces of gold, as they were in 1965, they'd be worth just 17 ounces. So congratulations, your stocks lost 30% of their value over the last 57 years when priced in real money. And what's even more crazy is this year, this week, the architect of this, Ben Bernanke, who basically created this crisis by creating this QE monster that's pushed us into the biggest bubble we've ever seen in history, was just given the Nobel Prize in economics as some sort of like a twisted joke just to kick us in the gut. So he was given the Nobel Economics Prize for his groundbreaking research on banks and financial crisis. It says that how he managed the financial crisis was better thanks to his research. They demonstrated the importance of preventing widespread bank collapses. All he did was engineer a way to make it bigger and worse in the future. He prevented it at the time, although millions of people still lost everything. Millions of people lost all their homes. But all he did was make the problem bigger and worse just down the road, and now we're paying for this. So now that we know what problems he's caused, it's insane to think that they would give him a Nobel Prize. But I think the Nobel Prize is ruined anyway, right? I mean, what's the Nobel Prize anyway? President Obama got the Nobel Peace Prize, which is pretty interesting. He got the Nobel Peace Prize after he dropped 26,171 bombs just in the year of 2016 alone. As a matter of fact, he dropped 3 bombs every hour, 24 hours a day. He dropped a bomb every 20 minutes and still got a Peace Prize for that. So I guess what are the Nobel Prizes worth anyway? They give it to Obama for dropping bombs. They give it to Bernanke for making the bubble bigger and worse than it's ever been. But it's the Federal Reserve that is giving you the American dream that you never wanted and stealing your life. It's communist. Point number 5 in the Communist Manifesto. Understand what we're doing here. You're listening to the Mark Moss Show. We're talking about the decentralized revolution, that the period that we know is coming to an end, and we are moving into a decentralized world. That's what I got for you today. I know it was a lot. Hopefully you enjoyed it, and thanks for listening.